Strange, it has not started the recording yet. I don't know. There's a problem with this Skype. Strange. Yeah, okay. So we would go with the treatment for leasing in the books of lesser. Okay, so yesterday we have done in the books of lessee. Today we are going to do in the books of lesser. So this is like accounting by lesser. As you know, like for lessee, everything, whatever the lessee paid was kind of a expenditure. Am I right? For lesser, it is what actually? For lesser, it is income. Am I right?
Yes, sir.
Yeah. So yesterday, this was like, which question we did? We did the first question, I think. This was the question we did.
Yes, sir.
Yeah, in the books of lesser, accounting by lesser, benefits to lesser. Lesser will get the interest revenue, correct? Whenever he will be collecting the lease from the lease income. For him, it is a income actually. So whenever he will be receiving the lease amount, that will be a combination of the principal element and the interest, correct? So interest is getting tax incentives since the asset belongs to lesser. So he can claim depreciation as a deduction. Am I right?
Yes, sir.
Yes.
Yes, sir.
And he will get a high leftover value. So economics of leasing, a lessor determines the amount of the rental based on the rate of return needed to justify the leasing asset. That means, see, if you have an asset and if you want to lease it out to someone, you would definitely see that you should get a good return out of that, correct? So he will be adjusting or he will be fixing the rate of return in such a way that he should get good benefit out of it. That means that the leasing should look to him as justified like leasing or justified way of earning incomes, correct? So if a residual value is involved, whether guaranteed or not, the company would not have to recover as much from the lease payments. That means if there is if the fixed amount is like the residual, there is a fixed amount what he is expecting as the residual value or terminal value or end of the lease term value. That means he expects some value that he may get that much of guaranteed value if he sells it. Then it is all right for him. He is not totally dependent on the lease payments or lease rental what is going to receive. Okay. So now let's understand the accounting by the lesser. So computation of rental. So this is actually not there in your syllabus. Frankly speaking, I am just explaining you out of the box. So let us see. Morgan Leasing Company signs an agreement on Jan 1st, 2007 to lease equipment to coal company. The following information relates to the agreement. The term of the non-cancelable lease is 6 years. So you can understand that this I'm speaking about a finance lease with no renewal option. The equipment has an estimated economic life of 6 years. The cost of the asset to the lessor is 2,45,000. Correct? That means he has bought it has costed him this much. Fair value is like of the asset on the 1st Jan is like 2,45,000. Asset will revert to lesser at the end of lease term. Like one of the conditions whereby there's no sale involved. That means the purchase option is not there. But like it's a non-cancelable lease. So one of there are 4 conditions it has to satisfy, correct? To qualify as a finance lease.
Yes, sir.
So like the asset will revert to the lessor at the end of lease term at which the asset is expected to this is the scrap value they are expecting. Agreement requires annual rental payments. So every year the rental payments have to be done. Collectibility of lease payments is reasonably predictable. There are no important uncertainties surrounding the amount of cost yet to be incurred by the lessor. So I would like you to read this question once again, and we can go for the solution.
Yes, sir.
Okay, shall we move forward, Zaina?
Yes, sir.
So see, first of all, we are computing the rental. Okay, assuming so we nothing has been given to us in the question, but you know, lease a lessor leases out the asset for some interest. He wants some return out of it, correct?
Yes, sir.
So everyone who does a business or invests definitely would they aspire or they expect something. So he's expecting 10%, and like we will be calculating the amount of annual rental payment required by him. So this is the scrap value, and this is the present value of that scrap value. Fine.
Yes, sir.
So this is a negligible value actually. We will remove it. We will remove this from the fair market value. That means this is a negligible value. This is the value which is almost all like like a scrap, or like almost all negligible thing. We are not going to consider it. Okay.
Yes, sir.
And this we were removing from the fair market value. We got the amount recovered from the lease payment divided by the annuity factor, which is for 6 years. The lease is going to continue at the rate of 10%. This is the annual payment required. Zarina, is it all right for you?
Yes, sir.
Have you done leasing anytime?
Yes, I have done.
In which
One time.
which course?
In CA only.
CA.
Yes, there was a topic.
You were doing IPCC or what?
No, in CA Foundation itself.
Actually, in CA Foundation they have leasing also.
Yeah, actually, in CPT it was not there. In new syllabus, I actually clubbed. A small
Okay.
part is there.
Okay. Not in detail. I mean to say. Okay. So like classification of leases by lessor, one is like so as I said you, operating lease, finance lease, and sale type leases. That means like sale and lease back. Okay. So like actually this is not there for you, Zarina. So I don't want to go into this. If you want to learn sale and lease back, I can give you one video whereby which has been like covered everything in details in that video. Everything has been covered. So now here we'll discuss something. Group one. So what is the capitalization criteria? It is not different from what we have discussed yesterday. Okay. And the second part for lessor, from lessor's point of view, it is very important that he should collect the payments from lessee, and there shouldn't be any uncertainty regarding the amount what he is expecting. Okay. A sale type lease involves a manufacturer's or dealer's profit, and direct financing does not. Actually, the thing is sale type lease is nothing but suppose there is a ice cream. Suppose you have an ice cream parlor and you have an ice cream machine, which which you would be using for giving ice creams to like making ice creams and selling the ice cream to the people. Now you want some capital to start a coffee vending machine, to buy a coffee vending machine, and you want to start a cafeteria, okay, along with the ice cream parlor. So what you can do, you can see for some lessors in the market. You can sell them your asset, the ice cream machine, okay, and they will give you a what we say a amount. Okay, suppose like you sold it for 7 lakhs or 8 lakhs, for example. So you got the amount, am I right?
Yes.
And they will collect 10 lakhs from you. That will be inclusive of interest for a long period of time. Am I right? They are sitting for what? For profit purpose, no?
Yes, sir.
So, but the thing is, the benefit to you is you have sold the asset and the asset is with you itself as a lease. Okay.
Yes, sir.
You have sold the asset. Here the sale means you have just given the title deed or title papers of that asset. Okay, but still you're using that particular machine in your parlor. You got money, and with that money you can start your coffee business also.
Yes,
So
sir.
the asset is with you, the money is with you. You're starting a business and you're paying fixed amount to the lesser. Okay, this is
Yep.
called sale leaseback. So all this is like yesterday's discussion which we did. Sale lease type I have explained you right now. Direct finance in the substance the financing of an asset purchased by the lessee. That means the lessee will purchase the asset at the end of the lease term. Correct.
Yes, sir.
So what they have given is they have shown a amortization schedule that would be suitable for lesser. So lesser is getting what actually, Zarina? The lease receivable for lesser is how much? 2,45,000. Am I right? And
Yes.
he got the lease. Actually, yesterday's question, what we discussed, in that the lease payment is paid at the beginning itself, on the day one itself. Okay.
Yes, sir.
Yesterday's question also we saw the lease was paid on day one itself. That reduces the liability outright. And then on the outstanding amount, the interest is charged. On the outstanding amount, the interest would be charged. So here, the lessor is receiving the lease payment outright on the day one. So 2,45,000 from 2,45,000 we deduct 46,000, and then the liability of that, so that amount is outright deducted, and that much liability has got reduced, and now the liability is 1,99,000 on which the interest will be charged 19,900. Then we have a combination of the principal element and the interest element, correct?
Yes,
And
sir.
this amortization would go till the end. Now you can check this out once, and then I will go for the next one.
Done, sir.
Yeah. Now same journal entries would come into picture. For him, it is like lease receivable to equipment which he has given out on lease, and cash to lease receivable when he is getting the first payment immediately, and then whatever the interest he is supposed to receive. So receivable to like first he would be expecting the interest. Am I right? So receivable to revenue. Then we will divide this cash. One is like principal element, one is the interest element, and then for the next year again receivable to interest level. This will be continuing. Okay, this entries will be continuing. You can just have a look through this. Once you tell me, I'll just move forward.
Yes.
Zarina, you got that investment decisions PDF?
Yes, sir.
Hello.
That one, no?
Yeah.
I got.
Yeah, that is very good now. It's very
Yes, sir.
crisp.
Short. Yeah, it's like summary.
Yes, yes, yes. So that would help you out actually. You can see you cannot compare that with the Hawk one, but it is like still very crisp.
Yes, sir.
As you say, I'll just move forward. Okay. Shall I move forward?
Um,
Hello.
yes, sir. Yes.
Okay, okay. If you're recording, no problem. If you're writing it, no issues.
No, sir. It's done.
Okay. Accounting by lessor operating method records each rental receipt as rental revenue, depreciates the leased asset in the normal manner. That is for the operating lease. That is what we really know that. Okay.
Yes, sir.
And I like, can you just like, we will just check our Hawk book. I don't think all this is there. So we can, for the time being, we can close this chapter. If you want, I can explain you. It's the same thing what we have done till now. Same in the books of lessor, same in the books of lessee.
Yes, sir.
Okay.
Sir, did you send me this PDF?
Which PDF? Leasing.
Yes, yes, this one.
No, leasing I did not send. I need to send. I will
Yes,
send.
yes. Please send me this.
Okay. No, I'm asking, do you want to solve this question on your own or shall I do this question right now with you?
I'll solve, sir. No issues. If I have
No,
any
I'm
doubt,
asking. Sorry.
yes, yes. I'll do it, sir.
I'm just asking if you are fine with this, then I'll send.
I'll do, sir.
Okay, then I'm doing one thing. I'm sending this PDF to you on the Skype itself.
Oops.
So if you don't get anything, then tomorrow I can explain, right?
Yes, sir.
Okay, Zarina, then tomorrow's topic I'm right now discussing what we will start. And tomorrow we will take that topic completely. 2 minutes. So Zarina, I think I have given the integrated reporting topic to you now. I think you have finished that.
Yes, sir.
Yeah. So what we can do is tomorrow, I think we have discussed, we can do this now. Financial statements. Tomorrow I'll finish this topic for you because already
Okay.
cash flows I've given to you. I just
Yes, sir.
need to explain in the format of financial statements and the statement of changes in equity. I'll discuss everything tomorrow. I'll wind up this chapter. Tomorrow this is done. Integrated reporting is done. And I'll give you one question also, a solved question, a financial report question. Actually, in your books, it is not there. That is from ACCA, but I'll share with you. Okay.
Okay, sir.
Because it's a detailed explanation. So 1, 2, cash and cash equivalents is cash flow statement. 3, done. Then account receivable is already given, done. We can focus on inventory, investments. PP is there. So then we can go for property, plant and equipment and intangible assets. One session. We can target that. Leasing is already done for you here.
Yes, sir.
Accounting for leases, correct? Okay.
Yes.
So tomorrow's target is financial statements. We will do this financial statements tomorrow, first chapter.
The whole syllabus by when will complete, sir?
See, reporting, I'm just focusing on reporting right now. So you know that tomorrow this will be done. One, I'm telling you. Inventory, probably 2 classes. Investments, 2 classes. PP, 1 class enough. Intangible assets, 1 class is enough. Almost all, see, if I just target this, by this month, by this 20 or 25th year reporting part, I will finish completely. Reporting part. Hello.
Yes, sir. Yes, sir.
So this one part of reporting would be done. And then I will focus on this, Zarina, this one. Standard costing, variance analysis. This is there, no? This is a
Yes.
very big unit, but we can finish this whole unit in 1 week itself, this variance analysis. Okay.
Yes, sir.
And can I give you the some videos of some topics simultaneously?
Sure, sir. Definitely.
Okay. So why don't we do this thing? I'll just sort out any of the chapters and send the video to you. You can just work out on that. Okay.
Okay, sir. Okay.
Meanwhile, tomorrow I'll do the financial reports thing.
Okay.
Okay. Is it fine if I give you budgeting videos?
Yes, sir. I'll do it.
Okay, then I'll send you the budgeting videos. Simon, you can finish it. There are 15 videos. 15 videos is equal to the chapter, the entire budgeting chapter. So whatever, I will try to send you videos you can work out simultaneously. Okay.
Yes, sir. Like by part 1 and part 2, like by April they will complete.
Yeah, I tried to finish by April. How
Yeah,
about
because in May, like I think we have exam.
May? Which one? This one, na? May window.
Yeah.
This one, like you mean to say any of the like exam you're going to write in the May window, correct?
But yeah, in my first 1 week, part 1, and last week, part 1, part
Okay,
2.
then I'll do one thing, Zarina. As you're free at home now, I'll send you a couple of videos. Simultaneously, you wind up that one, and simultaneously here also I'll be rushing out. Okay,
Okay, sir. Like
that
if
we.
like we'll try to do at least 15 to 20 days prior to syllabus completion.
Okay, fine. That's okay then. We will do that then. If I give you the videos now, then things would move very faster. Okay.
Okay, sir.
So I'll do that now. I'll just send you today some of the videos. Those chapters you start winding up, and rest of the chapters I'll be taking in the class.
Okay, sir.
And I'll take the track of those videos. Whatever doubts you have, you can clarify in the class itself.
So this Skype videos will be like on Skype for how many days?
30 days. You want any video? I have all the recordings.
Okay, sir. Okay, no
You
issue.
want any of the video of investment decisions?
No, not right now, sir. I'll let you know if I know if I want.
Yeah, if you want, you can tell me. I have all the recordings. Okay, I just record every class.
Okay, sir.
Okay, Zana, then tomorrow we'll do financial statements. Thank you.
Thank you.
Thank you.